Welcome to Sterling Trading Tech's Roundtable video series. My name is Andrew Actman, and I'm the Managing Director of Business Development for Sterling Trading Tech. As a global provider of trading, risk, and compliance solutions, we thought it was important, especially during this time, to continue to have industry conversations. One thing that we've noticed this year between COVID and offering cloud-based real-time risk and margin is how important the ability to have a custom house policy is for both risk and margin management. We've invited Ravi Jan, recently published author on risk.net, and Sterling's Director of Risk and Derivatives to the Roundtable to gain insight on the importance of house policies and what is changing in the environment. Ravi, thank you for joining the Roundtable series. And to get started, please introduce yourself.
Thank you, Andrew. So as Andrew mentioned, my name is Ravi Jan. With my many years of experience in both trading derivatives as well as risk management and building risk technology, at Sterling, I have combined that experience to build out to build and architect some fairly sophisticated risk products. And as a part of those risk products, we built a new house policy builder, and that's what we want to
Thank you, Ravi. And don't be shy to talk about your recently published article on risk.net. I know that was a big win for you and also for Sterling as well. But to kind of jump right in, why don't you tell us a little bit about what is a house policy or custom house policies, and why is it advantageous to implement one of those?
Sure. So most firms, clearing firms or broker-dealers that offer leverage to their clients, essentially have to monitor the risk of the portfolios of their clients. As individual stocks move at different amounts, or volatilities change, or we have situations like meme stocks like GME and AFC. The risk is borne by the clearing firm or the broker-dealer offering leverage, and thus they need to be able to evaluate all their client portfolios under different stress scenarios, under different conditions. A house policy is a consistent way of looking at risk that is typically sanctioned or agreed upon by the risk committee of one of these firms as a way to measure consistently all the portfolios and to thus assess the risk. So having a house policy gives a clearing firm or a broker-dealer a approved, consistent measure of risk across all their portfolios.
And when we're talking about sort of clearing firms, broker-dealers, are we also talking about potentially hedge funds? Can these be retail firms, proprietary trading firms that can benefit from these either house policies or custom house policies?
Sure. It is not uncommon for a risk manager at, let's say, a multi-strategy hedge fund or a prop firm to establish certain rules and a set of different risk metrics that he or she wants to use to hold all their traders or portfolio managers to. So absolutely, it's very valuable for such risk managers as well.
Got it. And so what are some of the analytics or risk metrics or measurements that firms are using today?
So there's a huge variety of different risk measures that firms are using or should be using if they aren't. First of all is shocking your portfolios under different scenarios, whether those scenarios be based on fixed percentage shocks, whether they're based on beta adjusted shocks, or they're based on standard deviation shocks. So shocking different symbols based on their idiosyncratic risk is really important. Secondly, to be able to shock option portfolios, the volatilities of option portfolios, implied vols. As we've seen in particular over the last couple of years, implied volatility itself is extremely volatile. And if you have clients that are trading options, you need to be able to shock both underlying prices and volatilities. So that's one. And those shocks can be set up as some standard shocks, or they can be set up as based on historical scenarios. So you can set up a scenario for what happened on 9/11, or what happened in 2008, or what happened when, March 2020. So you can set up historical scenarios also as a part of your risk policy. On top of that, other measures are VAR, and there's different types of VAR measures that are very useful in evaluating the risk of a portfolio. In addition to this, you must look at liquidity risk, so that you don't have portfolios with positions on very illiquid symbols, such that there's going to be a high cost of liquidation in the case of a bad event, if you will. And then concentration. A concentrated position can be expensive to liquidate, or can pose extreme amounts of exposure if something unexpected happens. So liquidity risk, concentration risk, VAR, stress tests, and then other measures like sector-based concentration, the option liquidation. If you have very, very large option positions, then liquidation of option positions is a very difficult thing to measure. So you must have some limits or controls on those. And all that I've mentioned is outside of the regulatory. Then from a regulatory perspective, there's also, for portfolio margin, calculating the regulatory portfolio margin requirements and add-ons to those.
Yeah, so that's interesting, because one of the things I've noticed over the last 2-3 years is that historically, regulators or even firms would really focus on the margin aspect, right? These are the margin requirements, whether it's the OCC TIMS methodology or it's Reg T maintenance, and then they would view risk separately. But I think what I'm seeing, and I think you can attest to that, is that people are starting to view both risk and margin together. And I guess what I would ask you is, how are these house policies used for regulatory requirements? And how does FINRA now view these as we start to see risk and margin being viewed together instead of separate and distinct?
So you're absolutely right, Andrew. Traditionally, regulatory requirements using things like portfolio margin or Reg T was one side of the equation, and risk managers would do their own analysis. But FINRA and in general, the industry has realized that market risk needs to inform margin. The margin framework, in particular the portfolio margin framework, just doesn't cut it today given the amount of idiosyncratic risk in the market. And so while you still need to do your portfolio margin type calculations for the regulatory base, it's important to augment them with various add-ons or use alternative policies that are purely shock-based and compare the two and take the worst case. So these days you see more and more even portfolio margin requirements from FINRA include both the regulatory TIMS calculations plus a lot of different shocks and different add-ons using the risk measures I mentioned earlier.
So then the $1 million question. Early on, you mentioned this custom house policy builder. Mm-hmm. How do you believe putting the ability to create your own custom house policies in the hands of end users, how does that provide leverage for the end client? Is it ease of installation, ease of change, the ability to create new things on the fly? What's the advantage of having that custom house policy builder?
All right, so let me just quickly tell you, well, first of all, the short answer to your question is all of the above. But let me explain to you what the custom house policy builder does. Most firms, they'll develop their own house policy with different risk metrics, et cetera, and then they have to get it implemented. And typically that implementation is bespoke coding, whether they go to their vendor or they go to their own internal teams to code it all up. And once it's coded, it's done, right? It's really difficult to change. If you need to change some parameter, you need to change your shocks, or FINRA says, we want you to widen out your ranges of shocks. It becomes a process. It becomes a very involved process to start going and changing your coding. What we've created is we've taken all the building blocks, like I mentioned, all these different risk measures. We've created building blocks. So one can literally take whichever building block you want and put it together to create your policy. And then you can edit, modify, change, or create multiple policies and a client can manage them themselves. Now think of the power of that. Let's say crazy things happen in the market, and all of a sudden you want to widen out all your shocks. You want to add more volatility shocks. In using a risk policy builder like what we've created, a risk manager can go in, modify those parameters, and instantaneously have an updated risk policy that's the positions are being calculated on. It's never been done before.
And Ravi, this can happen in real time or near real time, as we say.
It can happen almost in real time. In other words, you can make the changes, save it, and the new calculations will pick the changes up. So you can react very quickly to market and changes, market environments, or a changing risk in the market, which is really, really super powerful.
And I think then my next question and final question would be, obviously we see a lot of this in the US. Can this be utilized for global markets, the custom house policy builder or custom house policies in general?
Absolutely. And in fact, in certain global markets, in particular Europe, there isn't a regulatory framework like portfolio margin and Reg T. And so many global prime brokers or clearing firms actually develop their own internal risk policies. And our risk policy builder will support global markets, and thus one can build risk policies based on pretty much any market and capture the idiosyncratic risk of each of the markets within the policy.
Got it. Well, listen, Ravi, we appreciate your time and as always, your insight into both risk and margin. And thank you for being on the Sterling Trading Tech Roundtable video series.
Thank you, Andrew.